Hello, my name is Adil Abbas, and I'm a licensed financial advisor and co-owner of Own Financial Planning. In this workshop, me and my business partner, Dane Pimble, discuss with our expert guest, Michael Yeager, on how to save and invest smartly with investment bonds. Please note any opinions or recommendations you hear in this workshop would be considered general advice only. If you wish to act upon anything you hear about in this workshop, we strongly recommend seeking advice from qualified professionals prior to making a decision. Now, at Own Financial Planning, we have one simple philosophy for how we help our clients. It's that life is more than money, and money is simply the tool that enables our clients to live their best life. So it is our mission that in all of our advice, we aim to align money decisions with life decisions. And what are the factors which make life meaningful? And as you can see on the slides, the results of a global survey, it's not just about having a big bank balance or material well-being. Yes, those are important, but for most people, it's their family and kids. As financial advisors, we see this every day. Most goals we hear from our clients are linked to providing a good life for their family and providing a financial foundation for their kids. Hence, we're really excited to deliver this workshop of investing and saving through investment bonds because it's a money strategy which caters to many of these life goals. Just a bit about Michael before I hand over to him. Michael is the New South Wales Distribution Manager for Generation Life, which is Australia's leading investment bond provider. He has more than 25 years of experience and has held senior positions across distribution and wealth management for companies such as Challenger, Real Estate Capital Partners, and AMP. He has a Master's of Applied Finance from Macquarie University, together with a Bachelor of Business and a Diploma of Financial Planning. He joined Generation Life in 2019 to help meet increased advisor demand following legislative changes in 2017 and the innovations that came after that. And Generation Life as an organization has an ongoing commitment to education and strategy development. So Michael, really welcome tonight. It's great that you're able to join us. So I'm going to hand over to you now.
Thank you, Adil, and thank you, Dane, for arranging tonight. Good evening, everyone. So tonight we're looking at investment bonds, and just to be clear, we're talking about a tax structure. So technically, it's a life policy through which you can invest. There's no insurance component. It's simply something issued by a life company like Generation Life, just to distinguish it from the asset class of bonds. So it's not a corporate bond or a government bond. In fact, you can select a number of asset classes and investment options, just like you might do with your superannuation or your other investments. You have a menu capability via the investment bond structure. So I'll just say that, look, as Adil said, if you have any questions, drop them into the chat. We will pause from time to time and open it up to questions, taking yourself off mute. If there is anything that you'd like to inquire about that's not something you wish to discuss in a forum like this, then you can follow up with Dane or Adil afterwards, and they'll liaise with me if you're seeking some specific information based on what you hear tonight. I will have a disclaimer at the end, just to continue on from that Dane and Adil provided. This is all general in nature. I'm not in a position to give anyone personal advice. If you engage someone like Dane or Adil, they're in a position to do that. I'm representing Generation Life as a product provider. So our focus for today, we'll discuss investment bonds, which really are the fifth tax structure that you can invest in. We'll look at how they work and the features and benefits. And really, it's about tax-aware investing, which is a huge theme in the US and in Europe. Less of a focus in Australia, but that's changing. And we'll talk about what that means. So really, it's about being smart around your tax planning. We'll cover off on things like Division 293, which is when you have to pay extra on your super contributions when your income achieves a certain level. There's things like the super death benefits tax. Division 296 is in the media at the moment. That's a new double tax on larger super balances. The stage 3 tax changes have come through effective 1 July. And all of this ties in with a more effective management of your wealth as you live, but also looking at intergenerational transfer of wealth. And that's what links to estate planning. So even though estate planning for most of us is something well down the line, some of the decisions that you make today can better position you for structural and tax outcomes that are more effective for your children, grandchildren in the future, or your surviving spouse. And we'll cover off on a couple of case studies just to bring that together. So if we go to the next slide, Adele. So just a little bit on Gen Life. We are the leading provider of investment bonds in Australia. More than $3 billion under management. The majority of that has come in the last 5 years or so. And this is all we do. We specialise in the Life Act, is the legislative sleeve in which you find annuities, where friendly societies operate, where you will find investment bonds, which used to be called insurance bonds. So we're a specialist in that area. We're the market leader. We're attracting more than 50 cents in the dollar in the sector. And we've really been focused on innovation. So there's been a real renaissance in this type of tax structure. If you go back 10, 15, 20 years, these structures became very antiquated, especially as more money went into superannuation with the introduction of the superannuation guarantee in the 90s. What we saw was an opportunity to innovate and actually bring into the current day an older structure that has been reimagined and gives us some fantastic opportunities. And we're operating in an APRA-regulated environment. So it's a very heavily regulated environment. And Adele and Dane are very familiar with what that means as financial advisors. So if we move to the next slide. What is an investment bond? Well, I mentioned before that it is a structure, not a bond like a government bond. So technically, we're an investment-linked life policy. So basically what it is you have an owner or an investor or a policy holder, and then you have the policy or the investment platform. So these things have been around since the 1930s. They predated superannuation. And if we go back several decades, if you had money, you invested in shares through a stockbroker, or you might have an endowment policy through, someone at AMP or National Mutual, and then you had these types of structures. So then they were superseded with sort of, ETFs and managed funds and all the wonderful things that advisors have access to. And what we've really done is brought this structure back into the future with a modern approach where you have a comprehensive investment menu, and it's just a modern expression of that investment-linked policy. So we'll have a look at what it means as a tax structure in a moment. But essentially, there's no personal tax liability while the money's invested in the investment bond. So you're not creating additional personal tax for yourself. And in fact, after 10 years, there is no personal tax liability on any withdrawals. And we'll step through what that means. So really, we're a tax-paid legal structure, just like superannuation. So if you imagine when you put money into super, it doesn't impact you day to day. It's quarantined in that investment structure and it grows. Now, superannuation is preserved, which means you can't access it until you reach retirement or you otherwise meet a condition of release. The difference with our structure is you can access it at any time. And there's no distributable income. So it's not pushing out dividends or realised gains to add to your personal tax bill. It's all contained within the structure, and we pay any tax that's liable inside the structure, and we do that at the lowest rate possible that we can achieve as a life company. And as I mentioned before, you can invest in a range of investment options that you'd be familiar with, like you do with your superannuation and your direct investments. So moving on, this is really the key slide to position what an investment bond is. It is the fifth tax structure that you can invest through. Now, up front, I'll say we are not a silver bullet. We're not the be-all and end-all. You certainly wouldn't have all of your available capital inside our structure. We are just another option. And the job of a financial advisor is to make sure that you have the right money in the right place at the right time. For example, for the majority of people, superannuation is going to be the most tax effective environment through which to invest. But if you're in your 30s and 40s or even in your 50s, you may not like the idea of having your money tied up because it's preserved in superannuation. So you wouldn't have all of your money in superannuation. So by the same token, the investment bond, it's the right place, right time. But with all of these tax structures, there are limitations. And what we've highlighted here is where there are limitations with some of these other structures, the investment bond provides an opportunity to provide an alternative or a solution. And just to touch on a couple of those, for an individual, if you're on a high marginal tax rate and you invest money and that creates additional income, that will be taxed at your marginal tax rate. So if you're on 47% with Medicare levy, you'll pay that on your investment income. Okay, and if it's franked income, that's just a prepayment of your tax liability. Okay, at the end of the day, you keep 53 cents in that environment. If that same capital was in an investment bond, you would have a maximum 30% tax rate. In fact, with our tax optimised menu, you're looking at a range of 10 to 15% as an effective tax rate. So very similar to super accumulation. Okay, so the other way we see investment bonds being used as an alternative to superannuation. If you inherit money or you sell a business or you sell a property and you have some capital available to you and you don't want to tie that up into superannuation, maybe you're already well funded in your super and you're continuing to contribute and you're a little bit too far away from accessing it to tie up that capital, well, you might consider an investment bond because it's also a concessional tax environment, but it's not preserved. And in fact, you might end up withdrawing money from the investment bond and recycling that back into superannuation when you're closer to setting up your account-based pension. Okay, and that's where the advice is very critical too. But it just shows you that you can have very complementary strategies with the investment bond. The final thing I'll mention, and this is a very popular strategy where accountants and financial advisors are working together, is we're seeing a lot more bonds used inside a private trust. So where you have trust capital and you prefer not to generate income that needs to be distributed, if you put that available trust capital into an investment bond owned by the trust, there is no distributable income for you to manage. It's all contained within the structure. So it means you don't have to keep filling up that bucket company, which is just a tax deferral strategy. It means you don't have to distribute to beneficiaries of a trust who might already have a lot of income and are moving through those higher tax rates. So just to conclude on this, we are just another tax structure, another opportunity in the strategy mix. But of course, it's the right place, right time, depending on your own circumstances. And the 9 key features of the investment bond. Just to step through this. So we operate under both the Life Insurance Act and the Tax Act. Now, the Tax Act is what gives us our tax advantages and opportunities, and the Life Insurance Act is what gives us our structural opportunities. And I'll step through those in order. So number one, we have a maximum tax rate of 30%. Now we're achieving much lower tax rates for many of our funds, and that's through a combination of franking, but also capital tax management. In the past, one of the hurdles to people using insurance bonds, as they were called, is the fact that we do not get a capital gains tax discount, just like a company doesn't. So if you were a 47% taxpayer, you would think, well, if I'm getting a CGT discount on my investments, I'm only paying 23.5%. You guys are paying 30. Yes, I'm paying 47 on income, but on balance, it would depend how much growth, how much income, as to how effective it would be. The innovation that we've developed is we've started using the rules that were always there in the Life Act, but no one had built the operational capability to drive the rules. And one rule in particular I'm referring to is we are the only tax structure out of those 5 on the previous slide where we can offset a capital loss against income. And that's a very powerful thing when you're an institution. As an individual, that doesn't mean much to me. If I'm holding a very simple portfolio and I've held it for long enough, I won't have any losses, or very few, hopefully. So the idea of using losses against income, it's just anathema to a retail investor's approach. But when you're an institution like us, and when you have billions of dollars and you have tens of thousands of tax parcels, when you can offset a capital loss against income, and when you have the ability to manage your tax parcels, then it's a very powerful outcome. So traditional managed funds, say like, most people are familiar with the Perpetual Industrial Share Fund, which has been around for years. Those funds operate on a FIFO basis, first in, first out. So when you sell units or withdraw money, they go to the oldest tax parcel. And they do that because you're more likely to get that CGT discount. So it makes sense from their perspective. We operate on a HIFO basis, just like a managed account, which is another way of managing money in portfolios that your advisors may talk to you about. What that means is every time when we have a large investment option, say like the Vanguard Balanced Fund, and there's 500 million in there, whenever we pay Vanguard their investment fee, management fee, whenever we're paid our admin fee as the product provider, whenever we remit tax to the ATO, we can choose the most optimal tax parcel to fund that transaction. So most of the time we're reducing capital gain and reducing leakage, which means more money compounds for the benefit of you as the investor. But where possible, we will use tax parcels that create a loss. Now, they might be tax parcels that the underlying investment managers purchased last week or last month or 3 years ago. But because there are so many tax parcels, there are always opportunities to find reduced gains or losses. Now, here's where it gets really interesting. If I'm a managed account, so I'm outside of our tax environment, if I create a loss, like individuals and like everyone else, I have to carry that loss forward until I can use it against a gain. Because we're a life company, we have special rules. We operate on revenue account. So if we create a loss, we can offset that immediately against our income. So we reduce our tax bill immediately. And that actually returns a provision back to the investment to buy more shares or more units in investments. So it's a very powerful concept, but until we did the work, the rules were always there, but no one had built the operational capability to manage tax parcels. So think of it as us bringing a modern approach to investments and platforms and what the admin is behind modern superannuation products, and introducing that into the world of the old insurance bond to create an investment bond that is a modern version and achieves much better after-tax outcomes. So that's why we talk about lower tax rates than 30%. The second thing, number two, we don't generate distributions. So there's no distinction between a realised gain or income. Everything's revenue in our world, which is why we can offset capital losses against income, but it remains in our structure. Just like with your retail superannuation or your self-managed super fund, what happens inside that fund does not impact your personal tax return. Okay. That said, it's not preserved like super. If you wish to access funds, you can at any time. You just need to understand what the tax outcomes is, which we'll look at number 3. So we are a tax-paid environment. So there is no personal tax after 10 years. After 10 years, if you make a withdrawal from the investment bond, there's no tax. There's nothing going into your tax return. Okay, it's not assessable. Now, internally,
so that's a good benefit.
It is. It's a great benefit, and it's an additional benefit. That's not to say that there aren't benefits inside of the 10 years. So nothing goes into your tax return when you make a withdrawal after 10 years. What's not so well understood is, well, what happens if I want to access money inside of 10 years? And I'm not referring to the proportionate treatment in years 9 and 10, but there's a specific formula in the Tax Act, and it's called IT 2346, which determines the tax treatment of a withdrawal. I'll give you a very quick example. If I put $1 million into an investment bond, and at the end of 12 months, my withdrawal value or my balance is $1,050,000. So let's imagine it did 6% return. Gen Life, as the tax-paying entity, has paid $10,000 tax. Let's call that a 17% tax rate, which means if I now wish to withdraw everything, I would withdraw $1,050,000. But let's say I just withdraw the $50,000. So I'm back to my original capital. Now, if I did all of this directly outside of our structure, $60,000 worth of income, irrespective of whether it's franked or not, in the wash-up, I would keep, if I'm on the top rate, $31,800. 60,000 gross ends up $31,800. Why is the after-tax amount important? Because that's the amount that we consume, spend, or reinvest. Okay, all the other numbers are just headline numbers pre-tax. So let's go back inside the investment bond. 60,000 in income. Gen Life's paid 10 grand tax in this example, and now I withdraw that $50,000. So in both cases, inside and outside, I'm left with the original $1 million. But the question is, how is that $50,000 taxed? We go to the formula in IT 2346 in the Tax Act. The assessable component is determined by dividing the withdrawal amount of $50,000 by the balance at the time of withdrawal, which is $1,050,000. So $50,000 divided by $1,050,000 is 4.8%. Let's round that up to 5%. What that means is 5% of my withdrawal, my cash flow of $50,000, 5% or $2,500 is assessable. $47,500 is not assessable. So of that $50,000 cash flow from my investment, only $2,500 goes into my tax return. It goes into item 22 of the supplementary section of my tax return, proceeds of a life policy. There's a special section for it. It automatically gets a 30% tax offset. Now, in this example, Gen Life paid 17%. Now, it doesn't matter if we paid 0, 10, 25, 30, you always get a 30% tax offset. So just to finish the example, I get a cash flow of 50 by withdrawing 50. I get a 30% tax offset on the $2,500, that's the assessable component. If I'm on the top marginal tax rate, my top-up tax is $405. So we started with 60,000. Gen Life paid 10 grand. I pay 405 in top-up tax. My net outcome is $49,595 compared to $31,800 if I did this outside. So that is the amount I can now reinvest or consume. Now, I will admit that it's a very curated example to highlight a very optimal scenario where we're withdrawing the earnings. But what I'm demonstrating is inside of the first 10 years, it can be very tax effective depending on your strategy and why you're withdrawing. Now, importantly, if I invest $1 million directly, I get dividends, I get distributions, I have no control over that. And then I have to manage that tax. Inside the investment bond, you always have the choice whether to make a withdrawal or not, and you can stop, start, increase or decrease the withdrawal, so you have complete control. So you might have a year where your income's higher, so you don't take any income from the investment bond. You might have a year where your income's lower for whatever reason, and you want some extra cash flow. You can choose to make the withdrawal from the investment bond. But it's important to appreciate that after 10 years is when you get to a real optimal point where there's no assessable component on any withdrawals. So they're the tax side of things, 1 and 3 on this slide. 1 is the tax internal to the structure. Number 3, we talked about how tax works on taking money out of the structure. Remembering it's not preserved, you've got access to the funds at any time. And prior to making withdrawal, we can calculate what the tax components would be, where your advisor would arrange that, so you can make an informed decision as to whether you wish to make a withdrawal or not. Number 4 talks about the 125% framework. So with superannuation, you have caps on your concessional contributions. Now you have caps on how much you can put into an account-based pension and get to zero. We've got the Div 296, which is introducing a different kind of caps. You've got all sorts of caps in superannuation. Now, the superannuation cap applies on all of your super, your combined super. Our 125% framework, think of it as a cap, but on each individual bond or structure investment. It's designed to stop people from putting $1,000 in year one, not doing anything, and then putting $1 million in year 9, and then enjoying withdrawals from year 11 onwards where there is no taxable component. So what you can do is you have the option but not the obligation to contribute more into your investment up to 125% of the previous year's contributions. Okay, so that's just a framework that we manage. It's on an individual bond level. If you have lumpy cash flow, we see a lot of investors where they end up with multiple bonds because they can't contribute regularly to one, and that's fine. They'll just have their own separate 10-year tax periods. So number 5 is, in the context of some of the case studies we'll look at, is one of the more important features. Of those 5 tax structures on that previous slide, we are the only tax structure where you can transfer ownership from one legal entity to another with no tax, no stamp duty, and importantly, no restart of the 10-year tax period. It is the most portable structure. That's one of the benefits of operating within the Life Act. So we have our tax benefits via the Tax Act, but we have structural benefits via the Life Act. And one of the key ones is that portability. It's a unique feature for an investment bond. And this really drives a lot of the intergenerational transfer of wealth and estate planning opportunities. Because if you have money in other structures, you have different points, whether it's someone's death or just simply a decision to sell or transfer ownership, which will trigger tax and in some cases stamp duty. So that's a very, very powerful feature. So I can have an investment bond, I can transfer that to Dane, no tax, no CGT, no restart of the 10-year tax period. Several years later, he can transfer that to Adele, same thing, no outcomes. Adele can then transfer it into his family trust, once again, no CGT, no stamp duty, no restart of the 10-year tax period. Now, with number 6 here, just like with your superannuation, if you make changes inside your super, it doesn't create a CGT liability for you personally. But further, when you switch inside our tax structure, you're not creating any additional tax. Okay, so all of our unit pricing for all the investment options on our menu, all of our unit pricing is post-tax, net of fees. So you're moving from one post-tax position to another if you switch your investment options. You're not creating any additional tax, either inside or for yourself personally. Because if you have a managed fund in your own name and you switch from one investment option to another and you crystallise gains, that will create a taxable event for you and you have to deal with that in your personal tax return. Number 7, there's no tax file number required. Why? We are the tax-paying entity at GenLife. We do all the heavy lifting, all the admin, all the tax return work. If you make a withdrawal inside of 10 years, you will get a tax statement with the components. When you make a withdrawal after 10 years, there's no tax statement. You just get a confirmation or a benefit statement. Okay, so from a tax point of view, very easy to manage. Number 8 is important, creditor protection. So not only is the capital inside an investment bond creditor protected, but if you unfortunately went bankrupt because a business deal went south or some unfortunate event happened, the money in the investment bond is not available to your trustee in bankruptcy and it's not available to creditors. Further, if you make a withdrawal from the bond, that's also protected. Okay, so it's a very interesting structure for people who are self-employed, professionals who are always at risk of being sued. So it's an important feature and a very powerful feature. The final feature, number 9, investment bonds can be structured as non-estate assets. So when you have an estate asset and someone passes away, those assets are dealt with by the will and probate process if there's a will in place. You don't want to die intestate either. Make sure your wills are up to date. That's one tip I'm happy to give anyone who'll ask, and that's having dealt with a number of estates myself in my family circle. The benefits of having an up-to-date will cannot be underestimated. But with an investment bond, you can make a nomination. So you either nominate a beneficiary or multiple beneficiaries, or you can nominate a transferee. So a transferee will receive ownership either at a future date that you nominate or at your death. Now, once you make a nomination, it becomes a non-estate asset. It's not part of that will and probate process, which can take months and even years to sort through. These funds become immediately available to the beneficiary or the transferee outside of that will and probate process. So it provides immediate liquidity. So it's a very powerful tool in the mix of all of your other affairs. So you might have a self-managed super fund, a family trust, you've got all these other investments, the family home, all that sort of stuff will go through the will and probate process. Joint assets will go to the other party, of course. But these instruments will either pay out tax-free to a beneficiary or the ownership will transfer, and it's outside of that process. So very good for leaving money to adult children or to grandchildren so that they have immediate access to funds. So those are the 9 key features. I think if we move to the next slide, that might be an opportunity for questions, if there are any. Do we have anything on the chat?
Not yet, Michael, but I guess if
that's great. So
we'd like to
we'll keep questions. Okay, so are there any questions? Otherwise, we'll move into the 5 key uses, and we'll have more opportunity for questions as we go anyway. So, okay, so the 5 key uses of investment bonds. One is clearly an alternative to superannuation, a very similar tax outcome to super accumulation. Now, the best thing about super is you can access that zero tax environment at retirement when you set up your account-based pension. But of course, you're now capped to around $2 million. So if you don't want to tie your money up in super, you can use an investment bond, a similar tax outcome in terms of the super accumulation tax environment. And you always have the option of recycling funds from the bond into super closer to your retirement. And I don't want to go into any specific strategies. We've got some case studies, but advisors are very well equipped to understand that if you're in your 40s or 50s, you have surplus cash flow, you build that up in the investment bond, you're also doing super. And then when you're 5 years out from retirement, you might think, okay, we've got this money in the investment bond. My super's done really well because I've been salary sacrificing or I've had a generous scheme with my work. My partner, they worked part-time a bit or was self-employed, maybe had time off raising the kids, not such a healthy super balance. We can take the money out of the investment bond, and if it's after 10 years, there's no tax consequence, and we can use that to then consider, catch-up contributions, bring forward contributions, all of those opportunities that your advisor can speak with you about. But it's an example of where the investment bond complements super. It's an interim vehicle to give you tax effectiveness today, but the opportunity to optimize your super tomorrow. So alternative to super, that's a huge one. Number 2 here, estate planning, being in control and the transfer of wealth, that portability and the ability to set up these investment bonds so that the right money goes to the right person at the right time. Very powerful, especially just as a subset of your affairs. Blended families is a big one. I want this money to go to this child at this time, and I don't want it to be involved in my trust or other activities. If I have money in an investment bond, it's a very simple and elegant solution to wanting money to go to that particular child, perhaps from a previous relationship. Number 3, the traditional use of insurance bonds back in the day was saving for children. That's still a very valid strategy. I mentioned before, trust is a huge one. Reducing or managing distributable income within trust. That's a big opportunity. Accountants are now switching onto that as financial advisors are working more with them. And then we do have some strategies where you can improve your government eligibility, things like means-tested care fees. for people in aged care, or shielding assets from the income test. But I get the sense that the audience here is not really in that market potentially, but just showing you we've got a full range of strategies using the same structure, just in different ways. So moving on to, okay, so we just got a question here. Historically, how investment bonds performance compare? So that's a great question. So investment bonds don't perform. So we're not an asset class, we're just a platform. So it's like the question, how does super perform? Well, super doesn't perform either. It depends what you're invested in. So we have a full range of investment options, ranging from term deposit funds all the way through to international equities, balanced funds, and everything in between. So the performance depends on what investment options you choose and how they perform. So we don't actually invest, we don't manage money. We manage and operate the tax environment. And then you choose, with the help of an advisor, of course, whether you put money into Vanguard Balanced Fund or Magellan Infrastructure Fund or the Bennelong Aussie Share Fund. So, but what we do is we do publish the returns and the after-tax outcomes for all of the investment options on our menu, and we provide that information to advisors, and they can provide that to their clients.
I think that's a really relevant point, Michael, because you've mentioned this a lot as well in our discussions, is in Australia, it's becoming more prevalent overseas, but in Australia, often performance is typically quoted pre-tax. Now, what you actually receive as a benefit as an investor, depending on the structure, is an after-tax outcome. And so you can show, and we show our clients through comparisons as to how to address your point, Martin, the historical performance of the investments that are being recommended and what that after-tax return is compared to what you would have received if you invested in exactly the same fund, just in your own name or in a trust, instead of investing in the investment bond structure. So one of the key benefits is the tax benefits you get from investing through this structure without taking on any additional investment risk.
That's right. And so, if you're invested in a Vanguard fund or an iShares index fund or, the Hyperion Growth Fund, just to name a couple, and they're not recommendations, we're investment agnostic, but you're investing in exactly the same portfolio if you had done that through your super or through managed fund directly. So it's exactly the same portfolios. You have some timing differences, as you would in any case, when you enter the investment. So often we have investors ring us and say, look, I'm looking at the Vanguard website, their fund did 10%, your Vanguard fund did 8.2%. We'll say, yes, ours is after tax, their 10% is pre-tax, so take off your tax rate and then you'll get your net result versus our net result. So, which highlights, look, sometimes there are cases where someone's not paying any income tax, and they would pay more tax in our structure than they would directly. That might be a temporary situation, but typically they're not the sorts of clients getting financial advice. But what I'm highlighting there is that it's not the be-all and end-all for everyone, but for clients who are accumulating wealth and seeking advice, it's a very good environment to consider this now or in the future, depending on your circumstances. Adil, I think we've covered this. This is really just a graph, just showing you that over time, your investment grows, especially if you're contributing to it. And then the orange bits here are just showing you the taxable component of a withdrawal. You don't get taxed on your own capital, only on the earnings, but you do get that 30% tax offset. So with the stage 3 tax cuts, that's broadened the bands, which means that there's more opportunity to take withdrawals from the investment bond for people and use that offset and just be left with maybe some Medicare levy. So it's quite a tax effective way to access capital. And then, of course, from year 11 onwards, after 10 years, no personal tax on any withdrawals. So if we move along to this bit here, our competitive advantage in terms of driving those tax outcomes, and I spent a bit of time earlier, so I'll just quickly go through this, but You get franking credits as you would if you invested directly or a trust, and that flows through to the distributions. And superannuation is a great environment to use franking because 15% is below the franking level. So, and zero is even better if you're an account-based pension. But we're the same. Our maximum tax rate perfectly matches a fully franked dividend. And just to bring a very complex topic into one example, if we say it's a zero tax paid, say on an Australian share fund, that's because we've got fully franked income. So that 30% franking meets the liability of the fund. The fund has no additional tax to pay. So its effective tax rate is zero, the fund's rate, because the underlying manager has covered all the tax. If I was an individual investor on 47% tax rate, including Medicare, and I had the same fully franked income, my effective tax rate would be 24.28% because I have to gross up that franked dividend, and there's a gross up process, which means then I pay 24.28% extra. So that's really the power in having a cap at 30% versus marginal tax rates that are higher. And then we drive it down further through the orange column here, capital management. I mentioned we can offset capital losses against income, but we also do things like what a modern platform would do, say a Hub24 or a Macquarie Wrap or some of these new age platforms that advisors use. But we can net trades, which means if someone's putting money in and someone's taking money out, and they both want it in Vanguard, we'll net that off so that there's no buy-sell spread, there's no brokerage. Tax parcel management I talked about, but even things like we chase all the foreign tax credits in our portfolios. Why? Because we're focused on after-tax returns. 40% of all the foreign tax credits available to investors in Australia is lost because the fund manager doesn't chase it through their custodian because they're measured on a gross basis. They actually don't care. They don't know your tax position, so they don't do the work. We're the tax-paying entity. We know everyone's tax position. We chase down those foreign tax credits through our custodian. So that's it's a different philosophy. So I think moving along a deal. So that's the new generation investment bond. I've covered off on this, so I think we'll move on. And our tax aware, this really just brings it all together. Look, it's a unique structure, it's disciplined, and we're using the rules that were always there, but we've built the operational capacity to drive it. So how do we bring all this together to say, well, how do you quantify this? You talk about, after tax and your tax effective. We're just taking here one of our portfolio options, which is the tax effective Australian share fund managed by Invesco. What we have here is 1 through to 4 years. The left-hand column is the headline investment return. So that's the headline return in all of those columns. The shaded column shows you, in our structure, the tax-optimised gross after-tax return. You can then compare that to a 47% marginal tax rate, what their after-tax return is. We can compare it to a 39%. We can also compare it to a company. Now, when you think, and then, sorry, on the far right-hand side, we've got our tax optimized after-tax returns, but we've then taken off our admin fee, which for most investors is between 30 and 40 basis points. But just to show you the net result. It's interesting, we're a 30% taxpayer, that's our maximum. A company is 30% if it's an investment company, not a trading company. So why are we achieving a better return than the company? We both get franking. Neither of us gets the CGT discount, but this shows you and quantifies the benefit of our capital tax management. I mentioned all those things, offsetting capital losses against income, tax parcel management, cash flow management, contra trading, all those things that we do operationally is what creates that differential between the company investor after-tax return and our after-tax return. And so that's one fund. Let's have a look at a second fund, and that's the Vanguard High Growth Portfolio. You can see that our tax optimized after-tax returns after fees at the right-hand side, is outperforming the 47.39 and the company over 1, 2, and 3 year periods. So what we've done is we've been able to, and our appointed actuary is Deloitte. So what we're doing is we're auditing and publishing our results. When we launched all of this several years ago, we had back-tested data, and then we talked about what we thought would happen. Then we started replacing that with real data. So now we have, in this case, 3 years for Vanguard and 4 years for the previous fund, real data that has really proofed the concept of our thesis around managing tax in the Life Act. So moving along from here, what we call that is tax alpha. So for no additional investment risk, you're in exactly the same shares and property securities and government bonds and corporate bonds, depending on the portfolio. You're in exactly the same investment. You have the same investment risk, but we're creating additional return or alpha. So we've coined a new term. It's tax alpha. And that tax alpha compounds over time. And what that's really worth is, this is showing you from December 2019 through to December 2023, is a 1.88% per annum increased return for having exactly the same investment. Okay, so that tax alpha is going to be a bit of a buzzword. If we can help it, we'll certainly promote that. This is big in the States. This is all they focus on, and in Europe too. So we're just bringing that into the Australian market. So moving to the next slide. Any questions at this stage?
All right. Everyone's a little shy tonight.
That's okay. I will say, just further to that previous question about the returns, we have some investment managers, and again, this isn't a recommendation, this is an observation, but investment managers like Dimensional, like Invesco, and Fidelity, where they're actually managing their portfolios a little bit differently now because they're aware of our tax opportunities. So outside, they weren't so focused on the 45-day rule, which means that if you don't hold a stock for 45 days after a dividend's been declared, you lose your franking. They're more aware of the fact that if they do a trade and it creates a loss, let's say they want to trim a position, or they're in ANZ and they want to move to Westpac, and there's some losses in the parcels that they're using, they know that we will now use that to offset income tax. So they might make a decision a little bit differently. So we call that tax-aware investing. So basically you have two types of funds on our menu now. Funds where they just do what they normally would do. We handle all the admin, all the tax parcels, and we generate the tax alpha through our operational capability. But you have a growing group of investment managers where they're saying, well, we actually understand what you're doing, and we might feed some of that concept or that thinking into the way that we manage parts of what we do, just to make sure we're capitalizing on the opportunities. So we call that tax-aware investing, and we think it's quite flattering that companies like BlackRock and Fidelity and Dimensional are actually engaging with us, saying, "Well, we want to work closer with you in your tax structure because it is unique, the Life Act, especially for these overseas managers where they're not used to what we do over here." So, given there are no questions, let's just. Oh, we've got one here. What would you consider a minimum investment amount to make? So our minimum as a product provider is $1,000. So it's very easy to access. Remember, we get a lot of investment where people are just putting some money away for a child. It might be a grandchild, their children, godchildren. We've got a lot of that sort of business historically, but through advisors, we're getting larger amounts of money. It might be $1 million that's coming from a trust, and they're managing their distributable income, or someone has surplus cash flow of $5,000 a month. They don't want to put that into super, so they're putting it into an investment bond. So really, it ranges from $1,000, which is our minimum, through to every now and then we get like a $10 million case rolling through. And now with this Division 296 legislation, which is going to impact 80,000 investors where they have a super balance above $3 million. And as the legislation is expected to be passed, they'll be double taxed from 15, will go up to 30, including on unrealized gains. We'll see a lot more money, I think, that's lumpier coming from that. But so
I could just add to that, and I've seen Ranesh, you've got a question as well. Just
Sure.
adding to those comments, Michael, for Brendan's sake too. I think one other key thing to realise is if you're already putting money away to invest, and you might be sort of buying managed funds or whatever it is that you're doing, investing in your own name or through a trust or company or whatnot. All that really would change in that scenario is if you invested through the investment bond structure, you would be, in a lot of cases, paying less tax for the same investing. And because the structure doesn't have fixed costs, unlike setting up a company or a trust, which are very relevant in different circumstances, to Michael's point, you can invest in the Generation Life investment bond from as little as $1,000, and that's cost effective because it's a percentage based fee arrangement as opposed to fixed costs for the structure. Michael, did you want to? There's a couple more questions coming through.
There were two questions there. One was how quick is it to liquidate? So a withdrawal is like making a withdrawal from a managed fund, or if you're invested through a platform with non-super or even super, not that you're withdrawing, you might be switching. So it's up to the underlying fund manager. From our point of view, we're just the administration platform. So typically it's a T+3 environment. So if you're looking to withdraw money, generally it will be in your bank account within 5 business days, but often it's 3. So it depends whether we get the withdrawal notice before midday and that sort of thing, but it's like any other managed fund. So there's no difference. And we don't have any investment options that aren't liquid on our menu. Now, there was another question about wanting to understand minimums in the 10 years. So perhaps just to restate that the minimum's $1,000, but let's use an example. Someone's put $10,000 in year 1. They can put in up to $12,500 in year 2 without restarting the 10 years. So that's 125%. For next year, they could put in $13,750. Let's say in year 4, they put in $10,000 again. Year 5, they can put in up to $12,500. So it's always 125% of the previous year as your maximum opportunity. You don't have to put in contributions. So we often get $1 million in, and that's just in, and that's staying in for whatever period. But what's interesting, let's say in year 6, you want to put money in to keep the program going, but your business has a bit of a cash flow crunch and you just don't have the money available. You can just make a withdrawal, understand what the tax consequences are. Now, if your business isn't going well that year, you're probably not making as much money. Your income's probably lower. The 30% tax offset on the taxable component will meet most of, if not all of your tax liability, and you use that cash flow to contribute back in to stay in the program. So it's very flexible, and we manage that very tightly with advisors. So if someone writes to us and says, or emails us through or sets up a BPay and they say, look, I want to put another 10 grand in, if that's going to break that 125% framework, we won't process it until we check back with the advisor, or if there's no advisor, back with the direct investor, just to say, listen, you realise this is the outcome. And sometimes they say, look, it's year 5. This money's meant for the 21st birthday of my nephew. I don't mind resetting the 10 years. I'm just chipping away. Fine, but we make sure we check. Okay, so, and look, with investors coming through advisors, that's very well managed anyway at the advisor end. So now, looking at
what we would do
One
is
more question,
establish a second bond.
Yeah.
Yeah, you can always set up another bond. We have one investor in Melbourne who has $40 million with us across 24 different bonds. So very lumpy cash flow.
Yeah, Michael,
Yes.
sorry, maybe I wasn't clear. It wasn't about making deposits. It was if we need to access money, say hypothetically we invested next month. So we have a 10-year period accruing from next month. If 3 years in we make a withdrawal, is the 10-year period for the balance still 10 years from next month?
Yeah,
Or is
no,
it
okay. Great question. The only thing that impacts the 10 years is your contribution framework. Withdrawals, switches, none of that impacts the 10-year tax period.
Got it. That makes sense. Yeah. Thank you.
That's a good question, because we take it for granted that there are some moving parts, but the only thing that will impact your 10-year tax period is that 125% framework. Withdrawals and other factors have no impact. Transferring ownership, no impact. So it's a very flexible, but yeah, thank you for the question.
Just to clarify on that, Michael, does it 125? It's only if you exceed the 125%.
That's right.
If you still stay within the 125%, your 10-year mark is from the date of the initial investment. It's only if you end up going over, then you kind of reset the period again.
Yeah.
We won't let you go over. So
It's only going to go over.
we won't let you go over. So
exactly.
I mean, we talk about all this wonderful operational and admin capability. That's one thing we can manage very carefully. So, now just comparing super and investment bond, you can see that on the right-hand side, as you're looking at the screen, it's comparable in that they're both tax-paid structures. You have tax-free access and distributions. In the case of super, at death or once you meet preservation age or a condition of release. For us, it's 10 years or death. Tax reporting, very similar. You can switch without CGT. But on the left-hand side, that's where, notwithstanding that super is still the cornerstone of most people's financial plan. And it's about getting the right amount of money into that zero tax environment at the end of the super journey. But on the left-hand side, you can see that you've got access at any point. It's liquid. Super, it's preserved. You can use an investment bond as collateral to gear against. You can't do that with super. Our legislation, the Life Act, is a very simple and stable legislative environment. Super, it's very complex. It's always changing. The spirit of it won't change in that there'll always be an incentive to use super, and rightly so. But we're in a very, and to give you some context, super is a $3.5 trillion environment. That's why the government's so keen to, tax it where they can, and with the Division 296, the investment bond market's 11 billion. Now in the 80s it was 50 billion, but then super came along, and really all the money went in that direction. So as an $11 billion sector, there's not that much interest in, from a government point of view, in trying to squeeze more money out of us. We deal with the Grattan Institute on a regular basis. They've told us that when our sector gets to 100 billion, there'll probably be a little bit more interest. But that said, the Life Act governs annuity providers, friendly societies, risk insurers like Zurich and Tau. It's very difficult to change the Life Act. If they were to try to make changes, it would be in the Tax Act. But basically, the last change in our world was the Ralph Review recommended pegging us to the corporate tax rate, and they did that in 2002. So we don't think that there's anything on the horizon in terms of tinkering with this environment. If they were to do anything in the future, then they usually grandfather these sorts of provisions anyway. And the ownership transfer is so critical, and we have unlimited contributions. That 125% framework is at an individual bond level. There's nothing stopping you from opening up as many bonds as you like, and the amount that you put in to set up a bond is not restricted. It's not capped, like with superannuation. With super, they've made it very prescriptive on how much you can put in and when. With the investment bond, you've got full flexibility. So I think moving on from here, it's just showing you that next to superannuation, we're a great alternative. But I would always advocate that super is a wonderful thing for the majority of clients. So when we talk about investment tax management and the impact on advice, so tax bracket creep is such an issue. Now, these stage 3 tax cut or changes really, didn't make much of an impression on all of the creep that's happened over the years. I mean, it's nice. So the advantage relative to Division 293, great question. So Dane and Adele, so Division 293, that kicks in at about 250, right?
Yeah.
Yeah.
So if I'm earning $200,000, I inherit $1 million or I sell a business, I've got $1 million and I invest that and it gives me 6% return. So now my personal income's $260,000. My super contributions, instead of paying 15% contributions tax, I pay 30. So it doubles my contributions tax. That's the Division 293. If that same $1 million went into an investment bond, I still get the 6%, but there's no impact on my personal tax position. My income's still $200,000. I don't pay that extra 15% surcharge on the Division 293. So that's a simple way of explaining that.
Where we see that happening a lot is where some of our clients have set up salary sacrifices with their employer years ago, and their salaries have gone up over time, and the salary sacrifice was set at a fixed amount, and it's pushed them sort of over these limits. And so this is a way in which we can obviously work to manage that liability as well.
Yeah, if you're in your 40s and you might think it's only 2 or 3 grand, but what would that 2 or 3 grand have been worth in 25 years? And that happens every year.
Yeah,
it's a big leakage. So, and just to highlight, when we talk about unintended investment income can affect income tests and social security benefits. One thing that we're seeing a lot of is the Commonwealth Seniors Health Card. So this is for retirees. Now, maybe, I don't know how old everyone is here, maybe this is relevant for your parents or just for you to understand how the structure works. But the Commonwealth Seniors Health Card, the only measure for that card is your adjusted taxable income. There's actually no assets test. So if I'm a retiree, I'm self-funded, I don't get any age pension, but I get the Commonwealth Seniors Health Card. So I get some of those benefits. Let's say I inherit $1 million. So my older parents passed away, $1 million drops in. If I put that $1 million into a managed fund, or even if I can get some of it into super, because super is deemed, and then actual investments, direct investment, non-super investments, it's the actual income generated that determines your adjusted taxable income, which is the measure for the card. So all of a sudden, that pushes me up the threshold, either as a couple or an individual. Now I lose the card. If that same $1 million goes into an investment bond, there's no contribution to my adjusted taxable income. And guess what? Let's say I need money, and per that example, after a year, I pull out the 50,000, only 2,500 would go to my adjusted taxable income. And I've got the offset. But in terms of managing eligibility for the Commonwealth Seniors Health Card, it's a wonderful structure. And, so that's just showing you the benefit of not paying out distributions. You can apply it, whether it's inside a trust, for the Commonwealth Seniors Health Card, or for bringing down your means-tested care fees. So I'll let the advisors work out which strategies are relevant for different people, but there's a full range of things. It's just another tool, and it doesn't supersede anything. It's just where can we improve the situation by incorporating this Life Act tax environment. And the compounding effect of all this is really what matters. So I think if we move along, Adele, we'll try to get into a case study or two.
Yeah, Michael, I'm just mindful of everybody's time.
Yeah.
Maybe we do one case study, if that's okay.
Sure. That makes sense.
We'll be sharing the slide deck with all the participants. So
okay, we've covered this. They're just graphical representations of that marginal that tax bracket creep conversation. So you can have a look at that when we send that out. So
why don't we look at this case study, Michael?
Yeah, we'll look at this case study. So this is now looking at, okay, let's bring this into sort of a real life case. So Paul and Diane, they're in the late 30s, 2 young kids, and they're both on the top rate. Now, Paul's uncle recently passed away and he left him $100,000 in inheritance. And Paul and Diane already have some surplus income of $4,000 per month. So what they want to do is they want to work out how can they be tax effective. They want access to the savings to fund private school fees, maybe for travel overseas. Excuse me. And then they're conscious of the Division 293 tax. Excuse me. So next slide. So what this does is this shows putting that $100,000 in the green is if it goes into a managed fund. And in the yellow or orange is if it goes into an investment bond, and it's the exact same investment in terms of the underlying. So over 15 years, it just shows you that there are additional savings now of nearly $190,000. Now, what's interesting, this is just showing you the benefit of the environment. What I would be thinking about, though, is if I have 2 children, I wouldn't put $100,000 into one bond. I'd have 2 bonds of $50,000 each. Why? Because the beauty of this is down the track, if I'm contributing to it and it grows. So imagine now I've got young adult children and one child comes along and says, oh, Mum, Dad, can you help me buy a car? And I say, all right, well, you save 10 grand, I'll give you 10 grand. I'll take it from the bond earmarked for them. My other child says, listen, I've got an opportunity to study overseas, but I'll need $1,000 a month to just help me get by. I can take it out of the bond earmarked for them. So it's a very good way of maintaining estate equalisation and managing different needs. But if I'm looking to support my children, if I don't have separate bonds, then I have to think either if one gets $1, the other gets $1, or I keep a ledger in the back of a book like my late dad used to do. He was European. He used to have a ledger for everyone, who owes who what. But you can see how flexible it is. So often it's about how many bonds and why, and just to have the flexibility for something in the future. Excuse me. So that's usually a signal that I've done too much talking.
I know the feeling, Michael. There's a lot of technical information there, and really appreciate you sharing all that, and thanks to all of those that are on here. There's a lot to take in, and like we said, if there's anything that we haven't covered or anything that didn't quite make sense and you're not quite comfortable sort of speaking up in this session, by all means reach out to Adil or myself, and we'll obviously coordinate with Michael and make sure that you get the answers that you're looking for. And I think the real key out of all of this is just to remember that investment bonds are a structure. How you invest within the investment bond structure is the same considerations that you would be making for investing through your superannuation funds or any other structure, so to speak. So it's one that you'll pay less tax and then naturally have more money left in your pocket, along with a range of estate planning benefits as well that Michael's gone through.
I'd encourage you to have it when the slide deck is emailed out to you. Have a look at some of those other case studies. And I think on the back of today's presentation and discussion and some of the questions, it'll make sense. It just highlights that, for many of you, there may be an opportunity on the back of advice to work out how could this structure fit into what we're doing now or in the future. And even knowing the possibility might mean that you can work towards something and have an end goal in mind. So appreciate the opportunity, and nice meeting everyone.
Yeah.
Thanks very much, Michael. So as part of taking advantage of these investment bond structures as a way to tax effectively build wealth, I'd like to talk a bit about the 3 common portfolio construction styles: index, core satellite, active management. It's important to recognise when it comes to asset allocation that there's no perfect solution. There are pros and cons with all options, and the aim is to find the solution that best fits your needs and investment preferences. So a pure index approach seeks to give you the return of the index at the lowest possible cost. Unlike active management that is seeking to outperform the index, a purely index approach is the middle ground in terms of expected performance. There is minimal manager risk, as the manager is there purely to construct a portfolio to replicate the index. Your risk lies with the performance of the investment itself, not the manager's selection of investments. Jumping to the right of the slide, the active approach is seeking to outperform a chosen market. For example, an Australian shares active fund manager would typically be seeking to outperform the ASX 200. Active management provides for the potential to outperform a chosen index, and by default, this also means there are risks that it can underperform. Typically, active management comes with higher costs due to the greater research requirements in identifying the opportunities to outperform. It also comes with a greater degree of manager risk in that you are reliant on the specific manager you've selected or managers to perform better than the equivalent index option to justify these higher costs. Now turning to the middle of the slide, core satellite. So a core satellite approach aims to achieve the best of both worlds, combining an index approach at the core and taking a more active approach with the satellite positions in the portfolio. Thinking of the core as the sun and the satellites as the planets orbiting around the core. So the core stays relatively stable throughout the cycle, typically invested in a pure index strategy or something closely reflecting an index approach. The aim with the core is to minimize costs and transactions. The satellite component is the more active part of the portfolio. There are a range of different ways a satellite portfolio can be put together, but in general, it is the more active part. So at Own Financial Planning, we offer our clients 3 strategy options to consider. Index, and that's for those that want a simple, low-cost investment management solution. Core satellite passive. So in this strategy, the satellites are a combination of thematic exchange-traded funds that draw upon our market cycles research and an index like core. Core satellite active. So this portfolio is similar to the previous, however, it also includes active fund managers with a long-term track record of performance in their respective theme. Again, iShares provide the core component of this strategy as they do for the core satellite passive. And for all 3 strategy options, they're available across the 4 main risk profile levels, being conservative, balanced, growth, and high growth. And they are available for different investment structures, including inside superannuation, outside, and we've also put together a solution that works inside the investment bond structures that Generation Life offer. So quick comment on our investment philosophy that guides the investment advice we provide our clients. We won't go through all these points, but the key to highlight here is that it's your goals and investment preferences that dictate the investment strategy recommendations we make. Different goals require different strategies, and our job is to educate you on your options and guide you towards the option that best fits your needs. We're also firm believers that it is asset allocation rather than stock picking that is the primary driver of long-term investment returns. So while we have you, just a quick update on what we've got coming up in terms of workshops. Keep an eye out in your emails for the invitations to them. And we've got a number of exciting and experienced presenters across a range of very important topics. And if you want to discuss any of the details of this workshop and how it might apply to your circumstances, I'll invite you to book in for a complimentary clarity call, which you can access via our website, ownfinancialplanning.com.au, and just click on the contact page. And if you'd like to follow us on our socials, you can follow Own Financial Planning on LinkedIn, Facebook, or Instagram, and you can also find a number of educational videos on our own financial planning YouTube channel. Thanks very much for listening.